Okay, so here we are in question one that we worked in class on Thursday. We got a company buying a bond. It's a $1.8 million par value bond. Has a coupon rate of 10%. They bought it on 1/1/2015. They bought it at a discount of 107,550. So they paid the par value less the discount, or 1,692,450. This discount provides an effective yield on the bond of 11%. Interest is paid twice a year on July 1st and January 1st. And at the end of the first year, December 31st, 2015, the fair value of the bond is $1.7 million. Okay, a couple things I need to point out. One, there are two B's here. And here, there are two D's. So just be aware of that as I'm going through the solution here. So the solution in part A of the problem. Part A asks for the amount of interest income the company will recognize in 2015. You have to do a separate calculation for the amount of interest revenue to recognize in connection with the July 1st receipt of interest and in connection with the accrual at December 31st of the interest to be received on January 1st, 2016. So for the first 6 months of the year, we're going to recognize 93,045 of interest revenue, which is calculated by taking the carrying amount of the bond at the beginning of the period, multiplying it times the effective interest rate of 11%, and scaling it for half the year. That gives you the 93,045. The interest revenue for the second half of the year is calculated by taking the carrying amount of the bond at the start of the second half of the year at July 1st, multiplying that's the amount within brackets. I'll explain that in a second. Multiply that times the effective interest rate and scaling by 6/12 of the year, and that gives you the amount of interest revenue to recognize for the last half of the year. So the total interest revenue to recognize for the year is just the amount you recognize for the first half plus the amount recognized for the second half, or 186,339. Now the carrying amount of the bond as of July 1st, which is what appears within this bracket here, is calculated by taking the carrying amount of the bond on January 1st, 2015, that's the purchase price here, and adding to it the amount of discount that we amortized in connection with the entry that we made on July 1st, 2015 to record the July 1st, 2015 receipt of interest. And that was the difference. That amortization amount was simply the difference between the interest that we recognized, that we calculated up here, and the amount of the cash payment, which of course is based on the coupon rate. So the amounts within brackets here are the carrying, represents the carrying amount of the bond as of July 1st, 2015. Okay, part B of the problem asks us what amount of unrecognized gain or loss would ABC report in the income statement for the year ended December 31st, 2015 if the bonds are classified as held to maturity. And the answer there is that there would be no unrealized gains or losses reported in the income statement, because you don't recognize unrealized gains and losses if a bond is classified as held to maturity. The bond is simply carried in the accounting records at amortized cost. Fair market values are ignored. And notice, you remember that I said that there are two B's here. So this answer here applies to both held to maturity and available for sale. The reasoning, though, is a little bit different in the case of available for sale. In the case of available for sale, we do account for the unrealized gain or loss, but that unrealized gain or loss bypasses the income statement and goes to other accumulated comprehensive income as part of the equity section of the balance sheet. So you get the same answer, held to maturity versus available for sale, but you use different reasoning. Part C of the problem asks what amount of unrealized gain or loss would ABC report in the income statement for the year ended December 31st, 2015 if the bonds are classified as trading securities. If the bonds are classified as trading securities, then the any gain or loss is recognized as a part of net income. So here we would determine the carrying amount of the bond at December 31st, which is simply the balance in the investment and bond account, determined here to be the 1,698,789. Compare that book value of the bond to the fair market value of the bond, which is given in the facts of the problem to be $1.7 million, and the difference, $1,211, representing an excess of fair market value over the amortized cost of the bond. That's an unrealized gain, and that will flow through to the income statement as a part of net income if the bonds are classified as trading securities. The determination of the December 31st, 2015 balance in the investment and bond account is simply the purchase price of the bond here plus the two entries that we made to the account to amortize discount, in this case for the first 6 months of the year. In this case, that's the amortization for the last 6 months of the year. Okay, part D of the problem asks what we would report as part of accumulated other comprehensive income on the 12/31/2015 balance sheet if the bonds are classified as held to maturity. If the bonds are classified as held to maturity, there would be no unrealized gain or loss reported as a part of accumulated other comprehensive income, because for held to maturity bonds, the bonds are simply reported and accounted for based on amortized cost. We essentially ignore fair market value if they're held to maturity. If the bonds are classified as available for sale, any unrealized gain or loss bypasses the income statement and is reported in the equity section of the balance sheet as a part of accumulated other comprehensive income. So there is the answer to D. E asks us what amount would be reported as accumulated other comprehensive income if the bonds are classified as trading securities. If the bonds are classified as trading securities, there would be nothing related to the unrealized holding gain reported as part of accumulated other comprehensive income, because that gain runs through net income. And because it runs through net income is close to retained earnings at the end of the year, so that gain winds up on the balance sheet as a component of retained earnings. Whereas if the bonds are available for sale bonds, that gain bypasses the income statement and winds up on the balance sheet as a component of accumulated other comprehensive income. Part F asks at what amount the bonds would be reported on the balance sheet if the bonds are classified as held to maturity. Well, the bonds would be reported at their amortized cost, which is the balance in this investment and bond account, 1,698,789. So if bonds are classified as held to maturity, they're going to be reported at amortized cost of 1,698,789, reported in the balance sheet that amount. If the bonds are either available for sale or trading security, then the answer to 1G and 1H is that the bonds would be reported in the balance sheet at their fair market value. Okay, so when the dust settles, here's what we got. Interest revenue in the income statement is going to be $186,339, and that's regardless of classification, regardless of whether the bonds are available for sale, trading securities, or held to maturity. The income statement effect from the recognition of interest is going to be the same. Under held to maturity accounting, the bonds are going to be reported in the asset side of the balance sheet at their amortized cost. Under available for sale and trading security classification, the bonds are going to be reported in the balance sheet at their fair market value, $1.7 million. The difference between the carrying amount of the bond in the investment in bond account and the fair market value of the bond, that unrealized holding gain of $1,211 under available for sale classification, that gain goes directly to the equity section of the balance sheet, bypassing net income, and is reported as a part of accumulated other comprehensive income. That gain in trading securities goes directly to the income statement, and of course net income is closed to retained earnings, so that unrealized gain becomes just a component of retained earnings. In the case of held to maturity accounting, that unrealized gain is not accounted for. Okay, I think that takes care of question 1. So let's take a look at question 2 here. So question 2 deals with a company that bought 50,000 shares of common stock for $40 a share on January 1st, 2015. The 50,000 shares represents a 20% ownership stake in the investee company, which is XYZ. During 2015, XYZ paid cash dividends of $1 a share and reported income of $600,000. At the end of the year, the stock had appreciated in value a little bit. It was up to $45 a share, which is $5 share appreciation relative to what we paid for the securities. And part A and B of the problem ask us to explain the income statement and the balance sheet accounting or effects arising from the way that we account for this investment, assuming that in both cases we have influence over the operations of XYZ. The fact that we have influence over the operations of XYZ means that we have to account for this investment under the equity method of accounting. Under the equity method of accounting, the receipt of dividends goes as a reduction of the carrying amount of our investment, and what shows up on our income statement as earnings from the investment is our proportionate share of the earnings of the investee. In this case, we had a 20% stake, so 20% of $600,000 is what's going to show up on our income statement under Part A, since we're accounting for the investment under the equity method of accounting. So that's what this says. Okay, Part B, how does this show up on the balance sheet? Well, here's how it would show up on the balance sheet, given that we account for the transaction under the investment under the equity method of accounting. The $2 million, credit cash debit investment in XYZ when we buy this stock initially. When we got the dividends, we debited cash $50,000. We credited investment in XYZ $50,000. That's this. And then we prepared a journal entry to pick up our proportionate share of the earnings of the investment of the investee. And when we picked up those share of earnings, we did so by debiting investment in XYZ, crediting investment income by $120,000. So the carrying amount of the investment in XYZ asset account at December 31st, 2015, given that we are accounting for this investment under the equity method, is $2,070,000. So that $2,070,000 is the amount at which the investment is going to be reported on our balance sheet under Part 2B. Under Part 2C and D, it asks us to address again the income statement and balance sheet effects, assuming that we have no influence over the operations of XYZ and the investment is classified as available for sale. So in that case, we're just using fair value accounting of the type that we just discussed in connection with the bond. So we're going to report the investment in at the time we receive the dividends, we're going to debit cash, credit dividend income. So we would report $120,000 of dividend income on our income statement. And at the end of the period, the investment in the stock of the XYZ company would be reported on our balance sheet at fair market value, which is calculated by multiplying the number of shares times the price per share, or total fair market value of $2,250,000. Now, the excess of the fair market value, $2,250,000, over the cost of the investment, which is $2 million, that excess of $250,000 is an unrealized gain that's going to be reported as part of accumulated other comprehensive income in the equity section of the balance sheet. That gain will bypass our income statement and go directly to the equity section of the balance sheet as part of accumulated other comprehensive income, given that the investment is classified in part C and D as available for sale. So I believe that takes care of that problem. Okay, so on to problem 3. So we've got a company, ABC, sold a TV to a customer with a 2-year extended warranty for $600. The TV without the extended warranty sells for $500. The cost of the TV to ABC was $300. What impact will this transaction have on 2015 earnings? What impact will this transaction have on 2016 earnings? So what we have here is a multi-element sale. The customer bought two things. They bought a TV and they bought an extended warranty. We have two units of accounting: the TV, the extended warranty. What we have to do is we have to decompose the sales price of $600 into the portion paid for each of the units of account and apply the revenue recognition concept separately to each of the units of account. So based upon the facts, we can conclude that the customer paid $500 for the TV and $100 for the extended warranty. So applying the revenue recognition to the sale of a TV for $500, well, if you sold a TV for $500 that cost you $300, you're going to recognize $500 less $300 cost of goods sold, $500 sales revenue, $300 cost of goods sold. So you're going to report $200 of gross profit on your 2015 income statement from that part of the transaction. With respect to the portion of the sale that relates to the extended warranty, you're going to initially defer recognition of that $100 profit, establish that as unearned profit under the liability section of your balance sheet, and recognize it over the 2-year time span that the extended warranty is for. It's a 2-year extended warranty period. So we're going to take I got the wrong number here. This should be 50 and that should be 50. I wrote the wrong number down. So we're going to recognize $50 as part of 2015 income from this extended warranty, and the other 50 will be reported as part of 2016 income. Okay, big picture takeaway: multi-element sale. You partition the sales price into the part paid for each of the items sold to the customer. These things, each of the items sold to the customer, are called separate units of account, and we separately apply the revenue recognition concept to each of those separate units of account. Okay, so question 4. ABC sold a machine to XYZ for $200,000, and apparently this was a sale where XYZ didn't have enough money to pay us right up front, didn't have enough money to buy it on normal account, so we accepted XYZ's promissory note in the amount of $200,000, and XYZ is supposed to repay this promissory note over a 4-year period of time beginning December 31st, 2015. So XYZ is going to pay us $50,000 principal plus interest on 12/31/2015, again on 16, again on 17, again on 18. Alright, so part A of the problem asks us what's going to be the impact of this transaction on the seller's 2015 income, assuming that there's no significant uncertainty about collectability and ABC recognizes the profit using full accrual accounting. Well, you know, debit note receivable $200,000, credit sales revenue credit sales revenue $200,000, debit cost of goods sold $40,000, credit inventory $40,000. So $200,000 sales price less $40,000 cost of goods sold, $160,000 gross profit recognized on the 2015 income statement. So that's what the solution here to 4A shows. In 4B says, well, what if there is significant uncertainty about collectability of the sales proceeds and ABC recognizes the profit on this sale not using full accrual accounting as in A, but rather using the installment method of accounting. So the solution there is you first calculate the gross profit ratio. The gross profit ratio is simply the ratio of the gross profit on the sale divided by the sales price. And so we've got a gross profit ratio here of 80%. Take that gross profit ratio, multiply it times the amount of cash that we collected in 2015. In 2015 we got a $50,000 payment of principal on December 31st. So $50,000 times 80%, we would recognize $40,000 profit in 2015 under Part B, 4B, assuming that we use the installment method of accounting. Part C of the problem asks us to redo the accounting, assuming that there is significant uncertainty about collectability and that we use the cost recovery method. Here in 4C, we would recognize $10,000 of profit in 2015. We got $50,000 of cash. The first $40,000 of cash were deemed to be a recovery of the cost of the item that we sold, and only the cash received in excess of cost recoveries is recognized under the cost recovery method. So that would be basically $40,001 through $50,000 that we received in 2015 would be recognized as profit. So we would recognize $10,000 profit in 2015 under the cost recovery method. Part D of the problem here asks us to revisit the accounting. Here we're asked to assume that XYZ failed to make their agreed upon December 31st, 2015 payment and that we repossessed the machine in January 2016. At the time we repossessed the machine in January 2016, the fair market value of the machine is $170,000. Okay, so what we have in D is a repossession of an item sold on the installment basis. And the accounting there is real simple. You debit repossessed inventory to record the asset that is coming into the firm by virtue of the repossession. You remove from the accounting records the note receivable related to the sale. That's the note receivable that you recognized at the time of the sale. You remove from the accounting records the balance in the deferred profit account related to that installment sale, and the difference between the amount of the entry to the repossessed inventory account and the deferred profit and note receivable accounts. The remaining difference goes as either a gain on repossession or a loss on repossession. So in this case, the repossessed inventory, repossessed inventory is always recognized at fair market value. The facts tell us that the fair market value of the inventory is $170,000, so we're going to book that inventory at its fair market value, $170,000. The note receivable, we originally booked it at $200,000 on the date that we made the sale. The customer never paid us anything, so the balance in the note receivable account on the day that we repossessed is just $200,000. The profit, we originally deferred $160,000 profit on this sale at the time we entered into the sale. We haven't collected any cash under 4D, so the amount of the profit that we originally deferred is still sitting in the deferred profit account, so we have to remove that from the accounting records. And so what we need is a residual credit of $130,000 to make the journal entry balance, and that residual credit is going to go to gain on repossession. So again, when you repossess inventory that's been sold under the installment method, you debit the inventory account at its fair market value, you remove the carrying balance from the deferred profit account and the note receivable account, and whatever is needed to make the journal entry balance is the gain or loss on repossession that you recognize. Okay, so now we're on a construction problem here in 5. So we entered into a contract to build a building. The agreed upon price was $2,250,000. We began construction in 2014. We finished the construction in 2015. During 2014, we incurred $900,000 of construction cost and billed the customer $800,000. At December 31st, 24, we took a look at what we had done on the job, did some back of the envelope calculations of what we thought it would take us to complete the job, and we determined that it was going to take us about $600,000 we thought to finish the job out. During 2015, we incurred $675,000 more construction cost, and we billed the customer for the remaining $1,450,000 that was due on the job. Okay, so in part A of the problem, we're asked to determine how much profit we should recognize under the percentage of completion method of accounting. In part B, how much we should recognize under completed contract method of accounting. Under C, ask us for the balance in the construction and process general ledger account at December 31st, 2014 under percentage of completion. And then notice there's a typo here. D should say what's the balance in the construction and process account at December 31st, 2014 under the completed contract method. I goofed up. I did not change that from percentage of completion to completed contract. So I'm going to answer it the way I intended it to read, not the way it actually reads. I'm going to answer it in terms of the balance in the construction process account under completed contract accounting. And then finally, how will the construction and process and the progress billings general ledger accounts be reported in the December 31st, 2014 balance sheet account? So here are the basic facts that I just described to you. Here's our cost incurred: $900,000 in 2014, $675,000 in 2015. At December 31st, 2014, we thought it was going to take us $600,000 more job cost to finish the job. Our progress billings in 2014 were $800,000, and they were $1,450,000 in 2015. Okay, so what we got to do is we got to figure out what percentage of the job that we had finished as of December 31st, 2014. And the way you calculate that is you create a numerator where the numerator is cumulative job cost incurred. That's $900,000. The denominator here is total estimated cost to finish the job from start to finish. Total estimated cost to finish the job from start to finish is what we've actually incurred to date, which is $900,000, plus the $600,000 that we estimate that it's going to take us to finish the job based on our back of the envelope calculations at December 31st. So based upon cost incurred as a fraction of total estimated job cost, we're 60% done with the job. And of course, at the end of 2015, we're 100% done with the job. So part A of the problem, what are we going to report as profit in our 2014 and 2015 income statements? Well, our income statement's going to have revenue on contract less cost of contract for total gross profit amount. In 2014, the amount of revenue that we're going to recognize on the contract, this $1,350,000, was determined by taking the percentage of the job that we were done, 60%, and multiply that times the agreed upon contract amount, which was $2,250,000. So that $60,000 times the contract amount of $2,250,000 gives us the revenue that we're going to recognize here of $1,350,000. The job cost that we're going to report on the income statement from the contract is just the cost that we actually incurred that year. So the gross profit that we're going to report on our 2014 income statement is $450,000. Okay, for 2015, we're done with the job. We've earned all $2,250,000 worth of revenue. So what we're going to do is we're going to take the $2,250,000, the total amount of revenue that we've earned, subtract from that the amount of revenue that we recognized in the first year, which is $1,350,000, and the difference, $900,000, is what we're going to recognize as revenue in 2015. The amount of job costs that we're going to report as cost on the income statement is just the amount that we actually incurred that year, $675,000. So gross profit under percentage of completion in the second year is $225,000. Okay, that's the answer to part A of the problem. Part B of the problem asks us to answer the same question again, assuming completed contract method. Under completed contract method, no profit is recognized on the job during the construction period. Rather, all the profit is recognized in one fell swoop when you're done with the job. So we recognize all the revenue, $2,250,000, on the 2015 income statement, and we recognize all the costs that we incurred on the job as job cost on the income statement. Our total cost that we incurred start to finish on the job was the $900,000 from 2014 plus the $675,000 from 2015. Add those together and that's the $1,575,000 there. So total gross profit on the 2015 income statement is $675,000. So that's part B. That's what the income statement looks like under completed contract. Part C of the problem asks us what will be the balance in the construction and process account at December 31st, 2014 under under percentage of completion accounting. So here's what the account's going to look like, the construction process account. The $900,000 simply represents the job cost that we incurred. You know, at various times during the year as we either purchase supplies or consume supplies, you know, we credited cash or credited raw materials, whatever resource was being consumed was credited, and the offsetting debit was construction and process. In other words, we capitalized our job cost. Then at the end of the year, we prepared an adjusting journal entry to book this profit on our income statement, and the entry was credit revenue on the job, $1,350,000, debit cost of contract, $900,000. So that's how we got these two numbers on the income statement, and the offsetting debit to those entries was $450,000 profit on the job, went as a debit to the construction process account. Okay, so that's part C of the problem. Part D of the problem asks us to determine the balance in the construction and process general ledger account at 12/31/2014, assuming completed contract. Under completed contract, the T account is going to look exactly the same as under percentage completion, except that $450,000, which was the entry that we made under percentage of completion to get this profit up on the income statement, that's not present under completed contract method, because under completed contract method we don't recognize any profit on the income statement. So that entry would not be made. So the balance in the CIP account at the December 31st, 2014 is just going to be $900,000. Okay, so part E of the problem asks us how the construction and process account, this account, and the progress billings general ledger account, how will those be reported in the December 31st, 2014 balance sheet account? In the balance sheet. Okay, so the construction and process account, that normal balance of that account, it's an asset account, it's got a debit balance. The progress billings account normally has a credit balance, because when you send out bills to your customers, you debit accounts receivable, you credit the progress billing account. Normal balance in that account is a credit balance. What happens is at each balance sheet date, you take the balance in the construction process account, and which has a debit balance, and you net it against the balance in the billings account that has a credit balance. So if the net of those two accounts is a net debit, it's reported under asset section of the balance sheet, described as excess of job cost and profit in excess of progress billings. And if the netting of those two accounts is a credit balance, it's reported under liabilities, and it's described as excess of billings over job cost and profit. Okay, so that takes care of part E of the problem. Alright, so on to our last problem. And if you heard my dogs barking, well, sorry about that. Okay, so here we are, question 6. So on January 1st, 2015, the lessor leases an asset to a lessee. The asset had an economic life of 6 years, fair market value of $100,000. The lease term is 5 years. Lease payments are due on December 31st of each year. The lessor's implicit rate is 10%. The lessee's incremental borrowing rate is 11%. And the lessee is aware of the lessor's implicit rate. The residual value of the asset at the end of the lease is $15,000, and the lessee uses the straight line method of depreciation. Okay, so again, there's some typos here on this, and the typos are down here in E and F. In the E and F, I wanted you to book the lease in the lessee's records, not the lessor's records, because we've already booked up here. We've already booked the asset in the lessor's records. So I meant to say down here in E and F, book the asset in the lessee's records. Okay, so we're going to work it the way I intended it to be worded, not the way it is worded. E and F going to be worked based upon booking of the transaction in the lessee's records. Okay, so part A of the problem asks us to book the lease in the lessor's records, assuming that the residual value is unguaranteed and the asset is carried in the lessor's records at $100,000. Okay, first we need to determine whether this is an operating lease or capital lease. It's going to be a capital lease because the lease term 5 years, economic life is 6 years, 5/6 is more than 75%, so the lease term spans more than 75% of the economic life of the asset, so we've got a capital lease. So in part A, from the lessor's perspective, this is a direct financing capital lease because in part A of the problem, there's no evidence of dealer's profit. There's no dealer's profit because A, there's no indication that this lessor deals in selling this sort of asset, and the asset carrying amount of $100,000 is the same as the asset's fair market value. So direct financing lease. So in a direct financing lease with no dealer profit, the basic structure of the entry is debit lease receivable, credit equipment. The lessor is going to book the lease receivable in their accounting records at the present value of the minimum lease payments plus the present value of any unguaranteed residual value. Up here, I do the calculations for that. So the first thing we got to figure out is what lease payment is the lessor going to charge. So the lessor is going to figure that out by taking the fair value of the asset today, subtracting from it the present value of the residual value of the asset at the end of the lease term, and the difference between those two amounts is what he has to recoup from the lessee in lease payments. Okay, fair value of the asset given at $100,000. Residual value is $15,000. The present value of that residual value is calculated by multiplying the residual value times the present value of a single sum factor for n is equal to 5. I is equal to the lessor's implicit rate of 10%, and that present value amounts $93,140. So the lessor has to recoup from the lessee $90,686 in present value cents. So you set up a little equation that says some unknown payment amount times the present value of an ordinary annuity factor for I is equal to 10%, N is equal to 5 payments. That factor is 3.79079. Some unknown payment amount multiplied times that present value of an ordinary annuity factor equals what the lessor has to recoup from the lessee in a present value sense over the life of the lease. That's $97.86. So you simply solve for the unknown by manipulating the equation here algebraically, and you come up with $23,923. That's the recurring lease payment that the lessee is going to make to the lessor. So down here, the amount of the debit to the lease receivable account by the lessor is going to be equal to the present value of the minimum lease payments. In this case, there is only one component of minimum lease payments here. It's the recurring payment. The residual value in part A of the problem is unguaranteed. So the lessor is going to debit the lease receivable account for the present value of the minimum lease payments. That's calculated by taking the recurring lease payment amount of $23,923 and multiplying it times the recurring or times the present value of the ordinary annuity factor. That gives you $96.86, and the lessor is going to add to that the present value of the unguaranteed residual value from up here of $93,140. So the total debit to the account here of $100,000 is the sum of two numbers. It's the present value of the minimum lease payments, $96.86, plus the present value of the residual value of the unguaranteed residual value, $93,140. That's $100,000. And the carrying amount of equipment in the lessor's accounting records is $100,000. So that's the entry in Part A of the problem. Part B of the problem asks you to redo the accounting in the lessor's records, assuming that that residual value is guaranteed rather than unguaranteed. Well, the entry is going to be exactly the same, but the reasoning is a little different now. The amount of the debit to the lease receivable account is the present value of the minimum lease payments plus, well, there is no unguaranteed residual value, so there's no unguaranteed residual value to add to the minimum lease payments. But the minimum lease payments amount in Part B are different. Now there are two components to the minimum lease payment. There is the present value of the recurring payment of there's the present value of the minimum lease payment, which is $96.86. That's just the $23,923 lease payment amount times the present value of the ordinary annuity factor. That gives you $96.86. Plus there's a second component of minimum lease payments, which is the guaranteed residual value. The present value of the guaranteed residual value is $93,140. So the total present value of minimum lease payments in Part B is $100,000. The entry in B is same as the entry in A. It's just that your reasoning is different. Okay. Part C of the problem asks you to record the entry in the lessor's records, assuming that the residual value is unguaranteed and the asset is carried in the lessor's accounting records at $75,000, and the asset is considered inventory by the lessor. So those facts indicate that you've got a sales type capital lease here rather than a direct financing capital lease from the point of view of the lessor, because there's dealer's profit. There's dealer's profit. You know this guy's a dealer in this sort of item because it's considered the inventory in his accounting records, and because the carrying amount of the lease of the asset of $75,000 is less than its fair market value. So both of those are the earmarks of dealer profits, so we've got a sales type capital lease here. So the structure of the entry: debit lease receivable, debit cost of goods sold, credit sales revenue, credit inventory. Here's how you arrive at the amounts. The debit to the lease receivable account is determined by taking the present value of the minimum lease payments and adding to it the present value of any unguaranteed residual value. So that debit there is exactly the same as was determined exactly the same as in part A of the problem. The present value of the minimum lease payments was $90,686, and the present value of the unguaranteed residual value was $93,140. So you take the $96,86, add to it the $93,140, and that's how you arrive at this total debit to the lease receivable account. The debit to the cost of goods sold account is equal to the cost of the asset minus the present value of any unguaranteed residual value. The present value of the unguaranteed residual value here is $93,140. So you take the $93,140, plug it in here, subtract it from $75,000, and you come up with a $65,686. And the logic is, since this residual value is unguaranteed, that part of the asset hasn't been sold, so we're not going to recognize that as part of cost of goods sold. Sales revenue is credited for the present value of the minimum lease payments, which is this $90,686. And then the inventory is credited by the carrying amount of the item that we sold, $75,000. So that's the answer to part C of the problem, sales type capital lease, where the residual value is unguaranteed. Part D of the problem asks you to do the same thing that you did in C, except assume that the residual value is guaranteed. The debit to the lease receivable account here, that's debited for the present value of the minimum lease payments, which is $100,000. That's arrived at by taking the present value of the recurring lease payment, that's $96.86, and adding to it the present value of now the guaranteed residual value of $93,140. So the $100,000 is simply the present value of minimum lease payments. Sales revenue is credited by the present value of the minimum lease payments. Cost of goods sold is debited for the cost of the asset, and the inventory is credited by the cost of the asset. So if you compare part C of the problem here to part D, it's the same problem, but the only difference is that the residual value in C is unguaranteed, the residual value in D is guaranteed. And so you can see that the sales revenue account credit differs. The difference here is attributable to, in this case, the unguaranteed residual value is not a component of minimum lease payments, so it's excluded from this credit to sales revenue. In this case, the residual value is part of the minimum lease payments, and so it's included in the credit to sales revenue account here. So minimum lease payments here, present value minimum lease payments was $90,686. Here, present value minimum lease payments was $100,000. In both cases, the debit to the lease receivable account is the same. In this case, the debit consisted of two components: the present value minimum lease payments of $69.86 plus the present value of any of the unguaranteed residual value, which was $93,140. Here, the debit of $100,000 is the present value of minimum lease payments, because in part D of the problem, the residual value is guaranteed. Because the residual value is guaranteed, that's considered a part of minimum lease payments. The credit to the inventory account's the same under both. The debit to cost of goods sold, though, differs. Here cost of goods sold is reduced below the cost of the asset, and the amount that is reduced by is the present value of any unguaranteed residual value. Down here the residual value is guaranteed, so that there is no unguaranteed residual value to subtract from to reduce cost of goods sold by. So the difference in the two amounts here are attributable to, in this case, a reduction for present value of unguaranteed residual value. Down here there is no unguaranteed residual value. Okay, in E we're asked to book the lease in the lessee's records assuming the residual value is unguaranteed. Okay, if the residual value is unguaranteed, then there is only one component of minimum lease payments here for the lessee to be concerned about. That's the recurring rental payment. So the lessee takes the recurring rental payment, multiplies that times the present value of the ordinary annuity factor from above, and so the present value of the minimum lease payments is $96.86. So the asset is booked and the lease obligation is booked both at the present value of the minimum lease payments. In part F of the problem, we book the lease in the lessee's records assuming that the lessee has guaranteed the residual value. Structure of the entry is the same as here, but the amounts are different, and the difference in the amounts is attributable to, in part F of the problem, the guaranteed residual value is now considered a component of minimum lease payments, so the present value of the guaranteed residual value is added to the present value of the recurring rental payments, and the sum of those two present values is the $100,000 that we're booking the asset at here. In other words, the entry to E and the entry to F differ by the amount of the residual value, present value of the residual value. Part G and H ask us to calculate the depreciation expense. G, depreciation expense, is for the facts in E where the residual value is unguaranteed, and the depreciation expenses in H is for the facts in F where the residual value is guaranteed. So in G, we're going to take the amount at which we book the asset under Part E of the problem, $90,686, and divide it by the lease term of 5 years, and we're going to recognize $18,137 of depreciation expense each year. Part H of the problem, we're going to take the amount at which we book the asset in Part F here, which is $100,000, reduce that by the residual value, the guaranteed residual value of $15,000. Notice that we're not discounting the number now. So we've got $85,000 depreciation base divided by 5-year lease term, $17,000 in depreciation. So when you're depreciating a leased asset, if the residual value is guaranteed, that residual value is reduces the booked amount of the asset in determining the depreciable base of the asset.